Vetri Subramaniam, Chief Investment Officer at UTI Asset Management Company. Vetri, great to have you with us here. Good morning, Prashant this side. Thanks for your time.
Good morning.
How are things looking? We had a bit of a mini budget last Friday. I think with 2 or 3 days, into the mix, people are saying, well, it's not that big a deal. On Friday, it looked pretty monumental. But in any case, as we look ahead, Vetri, what are your thoughts? How is the market looking? We've corrected a fair bit over the last 3 or 4 weeks now.
Sure. So I think, Prashant, the only way in which one can at any point sort of, judge the attractiveness of the market is based on the valuations, not based on narratives. I think the market's effectively gone nowhere if I look at price levels for maybe 18 months or more. Earnings have come through during this period. But if I go back 18 months, valuations were way above the long-term average. In fact, it was sort of blinking red. I think the good point today is that with prices having gone nowhere, you've effectively seen valuations sort of come back into the comfort zone. It's still actually not even come back to the long-term average, but it's at least back within the comfort zone. So we would sort of say there's a lot more comfort with where valuations are placed today. If I were to point to a risk, which I think is something we should remain cognizant of, it is simply the fact that, to my mind, the earnings expectation, when I look at the consensus for March 24, it looks like a bar which has been set a little bit too high because 18-19% earnings growth in FY24 in the backdrop of everything that we know, an Indian economy which has anyway been showing signs of a little bit of a slowdown. You've got global problems, you've got interest rates which have moved up quite a bit. So to deliver that kind of earnings growth in FY24 is a little bit of a very high bar, in my opinion, when I look at the consensus, and which is why we would sort of look at the valuation picture and say, it's looking a lot more comfortable, but stagger your investments because it isn't really like valuations have dropped to a very, very attractive level, certainly not below the long-term averages yet.
Good morning, Vetri. I was coming exactly to that point that are valuations matching and mirroring this expected slowdown in earnings, and I think the consensus is that the RBI still isn't done yet. Over here in India, when central banks around the world are hiking, we'll probably get 25 basis points in the first week of April. So against this backdrop, is the valuation reset properly reflecting the expected slowdown, or is there more to go on the downside?
Well, if you were to think about valuations in terms of blinking green when they're very, very attractive, blinking amber, which is what they do at most points of time, and then blinking red when it is unattractive, you're sort of in that amber zone. You aren't really in that green zone for some of the points that you made. I think this earnings expectation of 18%, 19% for 24 is too aggressive. And, Surabhi, when I look at the earnings estimates, the FY23 line has been going with this steady decline for almost 6 months, whereas the FY24 line is sort of remained a flat line for 6 months now. And I think it's just that analysts haven't gotten around to sort of readjusting their expectations for 24. And perhaps you'll see a lot of that once this quarter's results start to come out. And, FY24 then becomes very much the operative year. So I think from that point of view, there are challenges. Internally, we also look at where are equity valuations relative to 10-year GSECs, because comparing the, Nifty earnings yield to the 10-year GSEC has typically been a good tactical indicator. If I go back even about 4 or 5 months, it was looking very, very unattractive relative to equities, and the needle was actually pointing towards bonds. Because of the recent sell-off, the indicator is starting to move towards neutral, but it's not reached neutral as yet as a tactical indicator. So, all of that is why we would sort of say, look at equities only on a staggered basis. It isn't really blinking green in terms of valuations.
All right. Hi, morning, Vetri. You make that point very well out there. Vetri, we're looking at the headline index and we're saying, well, we've corrected close to around 10%. But in the broader markets, it's been a far deeper correction. What should allocation be as of now? Because those mid and small caps, well, they are already corrected 20, 30, 35% in some cases as well. So you'll stick to the large cap names in equity allocation, or do you think now it's time to maybe look at the breadth of the market as well, the broader markets?
Sure. Nigel, the only point I'll make here is, look, the stock market is rarely a normal distribution. Right? It's always the case that something's going down harder than what the average number tells you. So that's always the case. Honestly, it's the same on the way up as it is on the way down. And this time around, I'd say more than the way down, it's really been more of a grinding correction going on for almost 18 months. So, there is always something which is going to do worse. That's the nature of the way the stock market works, because it's as close to, the market economy. It is the market economy, so to speak. Your second point really about where do we think the valuation preferences are, when I compare the valuations of large caps, mid caps, and small caps relative to their own history, I still find that it's the large caps which on a relative basis are the ones which are giving us more comfort. In fact, the small caps, even after the sort of more grinding decline which is shown up over there, actually compared to historical valuations is still looking more expensive on a relative basis. So we still don't have too much comfort in the small caps. It's actually the mid caps which I would say are somewhere close to the large caps, or maybe just slightly less attractive than the large caps. So if I were to stack it up, I would say large cap is the one where we have the best comfort today, followed by the mid caps, and actually the small caps, not just at number 3, but sort of bringing up the rear, because I would say there are still some valuation red lights over there. And just to add to that, Nigel, the current economic context is typically not a good one for, just from a top-down macro perspective, is not a good one for small caps. Slowing growth, pressure on margins, higher interest rates. Typically, this is not the mix which is favorable for small caps from a macro perspective.
Vetri, are you worried about the slowing growth, or you think it's just one of those years where things will pick up maybe into the election, or what's your sense really?
So, Prashant, the way I think about this is, look, maybe our potential rate of growth is running at 6% plus or minus 0.5%. Given all the challenges you have, if I look at where the consensus estimates for economic growth are, they tend to be sub 6. I know the government in its budget and the chief economic advisor have been more at 6 plus, but I think a 6% kind of medium-term growth rate for India over the next few years is certainly within the realm of possible. What we are not getting is an acceleration out of the pandemic, right? We got that initial acceleration in 2022, but it's not really following through. Now, we shouldn't ignore the fact that when I look around, the sovereign I would say in terms of fiscal health is in reasonably good shape, maybe 1 or 2 pressure points on the CAD, but otherwise broadly in good shape. The banking system and company balance sheets, honestly, Prashant, these are the best balance sheets we've seen in almost 15, maybe 20 years, right? I mean, 2003, 2005 is when I last saw company banks and bank balance sheets looking so healthy. So we've got a great setup. What we're not getting is the takeoff speed for GDP acceleration. Maybe that's a combination of everything that's happening in India and around the world. So we just have to be patient. But I don't think it changes our potential medium-term growth outlook.
Okay, well, we have to hold on to that optimism, Vetri. But in light of the present near-term reality that you described just a while back, what should the approach be to the market? And remember, we're talking about investors, at least on the retail side, even on the HNI side, whose patience has been really tested. Pretty bad 2022, not a very happy 2023 so far. So given the context, where should incremental money go? Where would you park it?
Well, I just point them back to history that there can be long periods of time where the market does nothing. I'm not making a forecast. I don't know what it will do. I've never known what it will do. But if I look at past data, there have been equally painful episodes, 2010, 2013, and I've written about my own career going back in the 90s where, you could say a drawdown went on for, many, many years. So, I don't think there is a particular rhythm that will always repeat. But, an 18-month grinding correction, I would say, is nothing unusual. It could last longer. Who knows? This is a time for people to sort of just reevaluate where they want to remain invested, which are the companies which can exit a difficult period. We talked about those strong balance sheets, strong cash flows in some companies. That is where you want to be positioned because those are the companies that will be able to press the accelerator when they see the times improve, whereas those with problems are actually going to remain challenged. The other point I would make is my natural thought process is always to look a little bit for contrarianism, where we start to see valuations already reflecting the worst possible outcomes. And actually, when we look at some of the areas like global commodities, particularly metals, when we look at some of the businesses exposed to Europe, I actually think on margin, a lot of the bad news is already factored into those valuations. And therefore, incrementally, I would tend to look at them for buying opportunities rather than staying away from them. So you've got to be a bit selective, but take a combination of who can come out of a difficult period, foot on the accelerator, and B, which are the businesses which have already been slammed in terms of valuation. Don't go by the narrative of global challenges, but if it's already captured in the valuations and the balance sheets are healthy, that's where you want to go.
Okay, that's sound advice, I think, and that people can hold on to, and also a reminder.